All right, Don Luskin, how do you see it? Weigh in, buddy.
Well, isn't it a strange situation where we have these investment banks and banks that a year and a half ago were too big to fail. Now they're too big to be held accountable because we're afraid that we'll bring them down and throw the economy back into recession. But I suppose that's the price we have to pay for having a banking sector. But, you know, the reality is that the practices for which Goldman Sachs is being held accountable now are absolutely widespread. Everybody did it, and it was in the nature of the beast. Because remember, this was not a CDO at issue here. This was a synthetic CDO, where the whole point was to bring together a long who loved it and a short who hated it. It was Goldman's duty to create a portfolio that maximized the conflict of interest between the two. So one of them would be a big winner and one of them would be a big loser.
Some people disagree with that, Don. Some people say this thing was designed to fail quickly. A lot of strong evidence, the way this thing was constructed internally, bad cash flows, bad covenants, a lot of problems with this.
Well, that's fine. There's nothing wrong with that inherently, and the SEC has not said that there is. The SEC simply said that the role of Paulson and Company in that design process was not disclosed, so that the long side of the trade didn't have all the material information to make a judgment about those things you're talking about. But those things themselves are not sins. Okay, so that's the issue. Well, maybe we will, but and a jury will decide. But the problem is, because of that strange factor that even you and I can't agree on, that's why the practice will be so widespread, because it falls into this gigantic gray area.
But would you buy banks now? I guess that's the bottom line question.
No, I wouldn't. I wouldn't have bought them before. I wouldn't have bought them before. The only thing that was keeping the whole U.S. banking sector a growth industry back in the good old days in 2005 was lending money to people who didn't fill out applications and didn't have jobs. That was their best idea. So what are they going to do now?
Well, and I think banks are going to continue to make an awful lot of money. Whether you think that's fair or not, or from a normative judgment, that's another story. But I would find it hard to be short them here.
Don, would you short them?
When you said initially, would I buy banks, maybe I misunderstood you to mean, would I invest in them?
Yes.
No, I wouldn't. Would I just simply buy them for a run to play off Fed cheap money? Maybe. But, you know, I think at this point I probably would be more likely to short them, because they have recovered so sharply on nothing but free money from the Fed. And now this sword of Damocles, not just the SEC, but state attorneys general and ambitious U.S. attorneys like Rudolph Giuliani and Spitzer and all those cockroaches, those people and their spiritual grandchildren are going to come out of the woodwork and nail these companies. So yeah, I'd short them. I admit it.
All right, short them. Good. Jason, we got that out of you. That's terrific. John Luskin, you're a money politics kind of guy. You heard Jason Trennert say a couple of 100,000 new jobs printed between now and year end. Does that mean the Democrats will hold Congress?
No, and here's the reason why. It's because it'll take in excess of 250,000 jobs every month through November to even keep the unemployment rate from naturally rising as people come back into the labor force and join the labor force anyway for demographic reasons. We lost so many from the labor force in the last 12 months. It would take 300 every month to move the unemployment rate down just a couple of basis points. It is not going to help the Democrats.
All right.